G'day guys, welcome back. In this video, we are going to talk about another LIC provided by Regal Fund Management. It has a ticker code RF1 and a management fee of 1.5% per year plus 20% of outperformance fee. The fund has been listed since 2019 for about 3 years. And what is amazing is that the share price has an annualized average growth of 23% per year. Not only that, in financial year 2021, it has reported 50% return on equity, higher than the previous year, about 15% ROE. I would like to thank Sumit for recommending us for a look into RF1. So in this video, we're gonna talk about the following points. First, what is the investment style of RF1? And to be quite honest, 50% ROE sounds like too good to be true. So the next question is it sustainable? Can they carry on this amazing return every year? And we're going to discuss the investment cost of this particular strategy that Regal Investment use. And lastly, we're going to talk about the recent scandal involving one of the portfolio managers in Regal Investment Fund that has not resulted in any action against Regal Funds Management. But I think this is a very important thing to consider when you are thinking of investing in any kind of companies. That is good and reliable management. Without further ado, let's get into it. Let's start with the recent balance sheet from the financial report 2021. They have a total asset of 850 million, up from the previous year of 720 million. They also have liabilities about 500 million, up from the previous year about 430 million. When you divide the liability to the asset, it comes down to the ratio about 60%. And straight away, you can see that their operation involves high liability, and therefore you have to consider that risk as well. Next, if you subtract the total asset with the total liability, you get the net asset. The net asset for 2021 is about 342 million, up by 17.6% from 2019 net asset of 291 million. Next, let's have a look at the statement of comprehensive income. Just a reminder, 2021 net asset is 343 million. As you can see on the first section here, they make most of their money through active management. That is net gain or loss on financial instruments at fair value through profit or loss. In 2021, they reported a net gain of 191 million, up from the previous year of 68 million. They also received dividend and distribution income, about 67 million for 2021. And you add up the total investment income minus the expenses, you get the profit and loss for the year. What is interesting as well is that they don't report that they pay any tax at all. So let me know if you have a reason why RF1 doesn't report any corporate income tax or capital gain tax. Aside from that, if you calculate the return on investment for 2021, we just divide 174 million divided by the net asset of 343 million, and then we get 51%, just like we mentioned before. However, as we can see, this active management hedge fund style involving derivatives and many types of financial instruments is very expensive. You can see the total expense for 2021 of 87 million, up from the previous year of 49 million. If you divide 87 million with the net asset of 343 million, you get a total expense of 25%. And the previous year is not any lower, with a total expense of 17%. If you consider another conservative LIC, for example ASIC and Argo, their total expense never exceeds 0.2%. So therefore, just looking at the 60% liability that they have, also the total expense that can go up to 25% of the net asset, it is a very risky business. And if you look at the statement of changes of equity, they also paid dividends. On the financial year 2021, they paid about $107 million, up from the previous year, about 24 million. They also do share buyback, 16 million for each year. So how do RF1 achieve this 50% return on equity for 2021? In one of the seminars, they mentioned that in this LIC, your fund is divided into 6 different types of funds, such as market neutral, long-short equity, global alpha, small companies, long-short healthcare, emerging companies. And you can see on the annualized gross return since inception, it has been really good. And they also invest in global equities, particularly Asian healthcare equities in Japan, Korea, China, and Hong Kong. I don't mean to sound negative, but investing in Asia is quite difficult because they have a different corporate culture. Now the next question is, do they really understand the business, or do they just going for a blind diversification and just looking at the movement of the share price chart? Because let me tell you, even understanding one business is quite difficult. And when I'm talking about understanding a business is that particular fund manager has a pretty good idea where the business is going to be for the next 10 years. In one of their slides as well, that they highlighted that it's really profitable to invest in the small caps, such as the one in the right hand side here, such as PointsBet, Zipco, Life 360, Megaport, Big Tin Can, as opposed to the top ASX 200 such as CSL, West Farmers, Rio Tinto, BHP. So really they're going against the current, because generally if you look at ASX 200, the top 20 companies is obviously the best performing companies in ASX, otherwise they wouldn't achieve that high market capitalization. And then they carry on at showing off the share price movement since 2019. They have small caps holdings in ASX such as Big Tin Can, Family Zone, Aussie Broadband, Dubber, and as you can see, the past 3 years, share price has gone really good. Now my question to this for small caps, is the business really generating wealth, or is the share price increase just by speculation? That is, the investor doesn't have a fair idea whether this is a good business or bad business. They're just hoping that the share price will go up. It sounds like gambling to me. What is interesting is that when I search up all these 4 names in the ComSec section for the financials, they have reported 5 years negative return. Imagine how much debt that they have accumulated. And we can carry on with Family Zone with another 5 year of negative return on equity. Next, we have Dubber with a 10-year negative return on equity. So my question is this a bad business or is it a good business? They can do return on equity as high as negative 100%. And even with the Aussie Broadband for financial year 2021, they reported negative 6% on return on equity. Remember, in short term, the stock market is a casino. In the long term, stock market is a weighing machine. Next, when I search up ASIC and Regal Investment, this will show up that ASIC has banned former dealer and portfolio manager Dylan Rance for market manipulation. Now it's starting to make sense how they can achieve such a great return on the small cap, while the small cap business is a bad business, it's not giving out any dividends, it has a negative return on equity, but they hire a portfolio manager that has done a market manipulation. And I found this news because on the announcement in November 2019 published by Regal Investment, the CEO has published this letter stating that Regal learned that ASIC is conducting a preliminary investigation by way of a search warrant. A search warrant that is pretty serious. And on June 2021, recently, the CEO published this letter about ASIC investigation that there is no action against Regal. But that does not mean it is okay for the CEO to hire this kind of talent. Let's have a read more with the ASIC statement that you can also look it up on the internet. Mr. Rand's pattern of trading involved purchasing Clearview Wealth shares, which had the effect of increasing or restoring the Clearview share price shortly following a price fall. ASIC also found that Mr. Rand is not adequately trained or is not competent to provide financial service and performs function as an officer and is likely to contravene a financial services law. This ASIC statement has been published since 22nd of September 2021, and I still haven't heard from the Regal Investment CEO explaining how he is not aware with this kind of operation. Any people with the rational and common sense understand how can you achieve such great return investing in bad business. is pure speculation. And I like to mention the ASIC statement that Mr. Rance be incompetent. But if you look at his CV on LinkedIn, he has been a Regal fund manager for 11 years. Since 2010, he was a senior fund accountant for 3 years and then carry on as a dealer for 7 years. Now, this is just one manipulation that ASIC can prove. Imagine if there is more in that 7 years. And if we look at his education, he is well educated from Macquarie University, Master of Applied Finance. And he has a double degree in Bachelor of Education and Bachelor of Business. So definitely there is something wrong here. With 11 years in fund management industry, plus a higher above average education, and yet he has done something that is against the law and is immoral. Because there's a disconnection between financial education in the universities and the reality of investment management. And the fact that they have been around in the fund management industry for years with the qualification in commerce or finance does not mean that they are good managers. Does not mean they have a good working ethics. So in conclusion, in the investment, beyond intellect, qualification, high IQ, and licenses, you need certain character, good character, and certain temperament to be successful. And most of the time, good management, good character that will look after and grow your money to be a great investment is very rare. We don't know how much of that market manipulation resulted in the 50% return on equity. If we just be rational, is that even the US corporate earnings growth is about 8% over a long period of time. My humble opinion, if you're looking for growth and dividend, consider market cap index ETF, such as S&P 500 and maybe Nasdaq 100. This kind of index ETF eliminates the risk of bad management. If they did bad and the company collapsed in the market capitalization, the next company will replace the seat. And to be quite honest, you don't need more than 900 companies to be successful in investment. You just need a few, maybe 2 or even 3 that you understand really well. Because maybe financial year 2021 may be the best performance of Regal. But can they continue the 50% on return on equity? I've seen a similar LIC investing in global equities with long, short, and derivatives involved in platinum asset management. As you can see, over the period of 12 years, the share price is very irregular and volatile. Because some years they've gained 100%, maybe the return is amazing, and then the next year is negative return. And what if you are bullish when you should be bearish, and you are bearish when you should be bullish? And not to mention, investing in over 900 positions in financial derivatives is very expensive, with 17 to 25% total expenses. That is a really inefficient way if you're talking about operating expenses in a business. And we also have seen some sort of speculation in small cap ASX companies. The company itself is really bad. It has a negative return on equity for 5 and even 10 years, and yet the share price is increasing out of nowhere. That doesn't make sense. So what I'm saying is, I doubt it that Regal can carry on this 50% on return on equity, because the investment style is very speculative, risky, and expensive. Thank you so much for watching, and I'll see you in the next video.